Hi everybody and welcome back to the channel. So this is another portfolio update with my Canadian dividend stock portfolio that I'm trying to build a passive stream of income to eventually replace all of my active income in the future. So the account balance of my RRSP and TFSA is 25,560, and while the RRSP is hanging on, doing pretty well, up 6.8%, our TFSA is not doing so hot, and it's now in the red by 5%. But there are a lot of great opportunities in the Canadian market, so I'm actually pretty happy about it. I get to buy stocks at a lower price. So with that said, let's roll the intro, and I'll get into my buys and the earnings of some companies that I own. And TFSA value is at 24,254, down 1% in the previous day. In the past week, we're down 2%. Past month, about the same. Past 3 months has been absolutely brutal to my TFSA, down 8% or $2,200 in the last 3 months. And what can I say? Those high interest rates are not having a good effect on the portfolio. But on the plus side, I do get to buy things at a lower price. So let's take a look at what's going on in the portfolio. So we can see that basically the entire market is selling off, at least lately. We see Apple dropping a little bit. It was in the 170 range. Now it's down to 160. First purchase that I made was actually into CNR. So I'm now up to 5 shares of this company. So I've built up essentially about half the position that I want to build in this company. And let's look into their earnings. So CNR did not have great earnings, but again, I looked at every single railway company and they all had a lot of trouble. So there does seem to be a lot of economic slowdown and there's lower volumes, especially being hauled by railways, but there were a lot of issues that led to that. So let's get into that. So operating income sank 21%, revenue fell 12%. Earnings per share declined 21%. Again, nothing good here. And the operating ratio rose, so their expenses rose as well. But volume was down 10%. Intermodal loads fell 23% due to the nearly 2-week Pacific dock workers strike in July and an overall slowdown in import activity. So there are a lot of headwinds and temporary issues that happen in the quarter. And the CEO did say on the earnings call, it was tough operating out there in quarter 3. We started out by dealing with the 2-week port strike on the West Coast and then faced constant disruptions from forest fires and flooding until September. So if you think back, when Canada had all those forest fires going, that disrupted rail, disrupted a lot of people, but it disrupted rail too, and flooding as well. And running to a plan makes all the difference. For instance, we had 2-day outage on our main line east of Edmonton in the quarter. In the past, it would have taken us up to a week or more to get operations back in sync. This one took 2 days. So it does seem like despite all the issues this quarter, that they are making the best of it and they're operating as efficiently as they can. So this is an unusually bad quarter for the company, but they do see and feel that the loads are going to be a lot better going forward. So they did have pretty promising outlook. They did say that the earnings would remain flat to slightly negative for 2023, but that in 2024 that the load should get better, and they do foresee more volume increasing, so we can get back to growing our earnings in this railroad. So overall, not great earnings, but pretty positive outlook. And if we just look at why the earnings were terrible, there were a lot of outside factors. We can't control the weather, so I think we can give CNR a little bit of a break here. And I purchased one more share of ENS, so this is how I invest in Enbridge, and we went from 108 to 109, so one extra share of this, paying nearly a 14% yield. And Enbridge has just been having a terrible year in terms of stock price performance. A lot of fear about this company because they're taking on a lot of debt to purchase some natural gas utilities from Dominion Energy, and the market just doesn't like the fact that Enbridge just has a growing amount of debt. and the fact that they are also diluting shareholders to make the acquisition as well. So it's kind of got people on edge about Enbridge and making them scared out of the position. I think that it will turn out good, but that'll remain to be seen. So in the meantime, I'm continuing to buy the company, and we'll see what happens with interest rates. The Bank of Canada recently paused the interest rates at 5%. I think if they do announce like cuts to the interest rates, if inflation starts to hit their 2% target, then we'll start to see stocks start to rebound. But as interest rates are really, really high right now, it's very difficult for businesses to grow, especially ones that rely on using tons and tons of debt to grow their business. And, you know, those interest charges that they have to make to service and pay their debts is definitely going to be a negative headwind for quite some time. So we'll see when that ends. But right now, I'm very comfortable just, you know, slowly getting more ENS here and there, increasing that monthly income. And right now, I'm just dripping whatever I get from this and just putting it into new shares of ENS to get more Enbridge. And I also purchased one more share of Granite REIT, so going from 14 to 15 shares. This one is in a nice little dip as well, so real estate is down immensely as well, so decided to get one more of this. Pretty close to the allocation I want. I think about 5 more shares and I should be about where I want to be. With my real estate, I kind of want to split 5 and 5% from with Granite and Smart Centers. That's the other real estate investment trust I really like. And Intel actually is higher than the price stated here. They actually had a pretty good earnings report. So Intel stock has gone up after their earnings, and honestly, this is a really, really good earnings report. Probably the best one I've seen from Intel since I purchased the company, so that's kind of nice for a change. So the EPS, the earnings per share, came up to 41 cents versus 22 cents expected. So Intel blew it out of the water for earnings, basically doing double what the analysts expected. As well, revenue is 14.16 billion versus 13.5. So they beat on the top and the bottom line. Another really cool highlight from this is that the operating expenses declined 15% from a year ago. So Intel is becoming more efficient. And Intel says it has 120,000 employees, down from 131,000. So they have fewer employees. They did do some layoffs, trying to become a lean company. And the CEO did say that the company would cut costs by about $3 billion this year. So again, just trying to keep spending in check as they're investing a lot into the foundry services. And one key thing with that is that it grew nearly 300% from the same time last year, so tripling. So 311 basically went from a $100 million revenue part of the business to a $300 million in a year, which is insane growth for any company. I don't care how small it is, how big it is, that is crazy, crazy growth. And this is the reason why I'm invested in the company, because I really think that this is going to propel Intel to make so much free cash flow once their investments are done, and then they can finally start reaping the rewards of all these investments. So, and they also said Intel said a major customer had committed to using some of Intel's capacity and had made a prepayment. So they're already getting more clients for their foundry services. So they're going to continue to grow this segment of the business. This is the one I'm really excited about, not the client computing, because, you know, obviously that's going to be down if PC sales are down like 30% from, you know, just the start of the pandemic and around that time when people were just getting all their PCs. And they actually had a really good outlook for the future quarter, and that they would see a rebound in PC sales, which is not really surprising because, you know, we're heading into the Black Friday holiday season, and usually that's a great time for electronics and people wanting to buy new computers. So definitely can see why Intel is very confident in a rebound in the PC market. So overall, great stuff. Very happy Intel shareholder, and really happy to see that the foundry services are performing to just a mind-blowing degree. I can't be any happier about 300% growth from a single year, and there should be a lot of growth to come. And the final company to report earnings in my TFSA was Microsoft. So this jumped a little bit after their earnings, which was actually quite good. So the earnings per share for Microsoft was $2.99 versus $2.65 expected, and the revenue was $56.52 billion instead of $54.50. So Microsoft just generated an extra $2 billion in revenue just out of thin air. So definitely beat analyst expectations on the top and bottom line. Revenue grew 13% year over year in the quarter compared to last year. And if we go down to the chart here, it actually shows the growth in their segments. So if we look at Azure in the recent quarter, which is their cloud services, which they're competing with Amazon AWS as the market leader, but Microsoft, very distant number two, very clear number two, reaccelerated their growth from 26% in the previous quarter to 29% in the most recent quarter. If we look at the dynamic products and cloud services, that has reaccelerated the growth. So we can see a deceleration from Azure from Q2 of their fiscal 2023 down to 27, down to 26. So people were thinking that, the cloud would just, stop growing and just continue decelerating, but Microsoft's defying expectations and reaccelerating growth in Azure, which is nice. Very high margin business for Microsoft. So very nice to see this number grow again by double digits. Office 365 went from 15% to 18% growth, so faster acceleration in their subscription model for Microsoft Office. And then Office and Cloud Services also grew by double digits. And then we also have their search, news, advertising. That's also up double digits. Server products and cloud services from 17 to 21%. So a lot of segments in Microsoft seem to be growing quicker. Windows commercial products and cloud services went from 2 to 8%. And then Windows OEM actually finally made a gain in this most recent quarter versus continual losses. So this is leading me to believe that there is a little bit of a rebound in the PC market, and we might see that going forward because, when Microsoft was down 39% several quarters ago, the PC sales were down about 30%. So that made total sense. No PCs, there's no need for a Windows license. That makes perfect sense. But as the sales of PCs go up, people need their Windows license, so Microsoft benefits from that. And even double-digit growth in their Xbox gaming segment from 5% to 10%. So overall, and they did recently acquire Activision Blizzard officially, so that's another thing that might help their Game Pass service to continue growing. So really nice double-digit growth from Microsoft in a lot of different segments, and very pleased with this company, and it just defies expectation. Microsoft is so big, people think the growth is done, but clearly not, as they're reaccelerating growth in their business. And this chart says it all. It really breaks it down well. And if you're enjoying the video, please do leave a like and subscribe to the channel so you never miss one of my updates. And if you all want more from me, and you can't wait for more updates, then you can follow me on Twitter, and I do share some buys and sells and a little bit of interesting news that I find in the market if you want to keep up with me there. So let's get to the dividends earned all time is 1887 and 40 cents. So this is approaching to 2,000. So that's going to be a really nice milestone to hit. I should probably hit that before the end of the year, so we'll see if I do that. Annually, my dividends projected for the year is $12.3147. The monthly average has increased from $101.91 a month to $102.62 a month. Daily, we're earning $3.37 instead of $3.35, so an extra 2 cents a week. And we are working towards my next goal of hitting $4 a day from dividend income, and $150 per month in dividends, and $1,500 a year in annual dividends. And as I hit these milestones, I will be, constantly raising the bar, setting the next goal for myself to keep myself motivated to continue investing. So thank you so much for watching, and I'll catch you guys next time.